Good morning, everybody, and welcome to this next IMAP webinar series. Of course, we're all in the business of building portfolios, constructing portfolios, and the classic 60/40 is the one we tend to talk about. But clients have other goals, and the purpose of this series is to really try and discuss some of the issues that arise when clients do have other goals. We're going to look at a couple of the standard scenarios. Today, we're going to be talking about retirement, tomorrow about ESG, and then on Thursday, we're going to be looking at how you construct a portfolio when a client or an advisor wants to include new economy investments or alternatives or thematics in the portfolio as a conscious decision, not simply as an alternative investment choice. We're lucky enough to be joined in this series by Daniel Stojanovski, the CIO of Ventura Funds Management, and Daniel will take us through the whole of this 3-day series of webinars. And before I hand over to Daniel and ask him to take us away, let me just say a little about upcoming events for IMAP. As I mentioned, tomorrow and Thursday, we'll be looking at two alternative types of portfolio construction when there are other objectives in play. For those of you who are contemplating entering the IMAP Managed Account Awards, the closing date is the 23rd of May. We've already had a good number of submissions, but I'd encourage you to enter the awards that are appropriate for your organisation. And finally, in July, our mid-year conference series, Advice in Action, will this year focus very much on issues of advice, practice, efficiency, and the considerations for advisors in running an excellent practice. We encourage your questions, and of course, down the bottom of the screen, you'll see the Q&A button. So now it's my pleasure to hand over to Daniel Stojanovski, our host, and ask him to take us away. Thanks, Daniel.
Thank you, Toby, and welcome everyone to this session. So I might just open up the session. So obviously, we're looking here at what are the difficulties in constructing portfolios for clients, specifically with that objective of that controversial, that 60/40 accumulation framework. I think that's something that we really wanted to sort of focus on in this session today, and some of the complexities and viewpoints around that. I'm joined with Darren Beesley from Evidentia, and he is the head of portfolio management at multi-asset Evidentia, and also Frank Danieli, the managing director and head of global credit solutions at MA Financial Group. Now, before I sort of hand over, what I really wanted to talk about and what we're sort of seeing, from Ventura's perspective, obviously running portfolios of our own, but also from the advisor perspective at Centrepoint, but really looking at retirement income. It's a really interesting sort of aspect where retirement income frameworks are really important, something that advisors really focus on at Centrepoint and when we're looking at retirement discussions. Overall, I like to break it down to sort of 4 sort of categories. The first we're looking at, obviously, and we like to talk to advisors about this, is that retirement portfolios are very different to that of accumulation. So that's number one, looking at the risks of the underlying portfolios. It's also very important, and when looking at essentially not being cued in how we allocate and what we're doing, the underlying assets are really important and what makes up that. Obviously, number 3 is having that framework, and that framework is really focused on, looking at it as pillars. So the portfolio being a pillar, annuity-like products and other bolt-ons that you can have, satellites, etc., in developing better client solutions. It also is very dependent on the client. And then lastly, that last approach of, okay, well, what is the philosophy we're trying to target? And obviously that process and that philosophy, when we're looking at it from a retirement perspective, is really around that, okay, what income am I paying? Is it capital preservation? What am I trying to achieve in terms of an objective for a client? I'd like to hand it over first to Darren Beesley from Evidentia, just how they think about, I guess, retirement portfolios overall. And I think that's something that we really wanted to sort of dig into this first part of the session.
Thanks, Daniel, and good afternoon, everyone. So I just wanted to kind of start off by giving a bit of history and thinking around three broad categories of how portfolio construction can be adjusted and improved from the classic 60/40 that we believe can improve the retirement outcomes. And they're kind of cumulative in a way. So the first one, as Daniel just pointed out, is what's the actual portfolio and what are we doing within that portfolio? And this historically in my life and in my career has been done in a fund. And so there's many of these around. It might be a model, it might be a fund, it might be an SMA, and we run some of these ourselves, which I'll get to. But really, what can we do within a fund better match the needs and requirements of the retiree investor as opposed to the accumulator? So the retiree might have a preference for less downside risk because they face sequencing risk and have limited capacity to replace capital. They might prefer franked income because they have a different tax status. They might prefer inflation-linked securities because their consumption is more closely tied to inflation over time. And so here we can talk about these attributes within a fund. But the important thing is what we do in there is basically something for every investor. It's a commingled one for many approach. So that's kind of the first thing. We can dive into that a lot more and talk about those attributes. And I dare say, Frank from MA is going to talk about the characteristics of investments that you put inside a retirement portfolio. So that's number one. And personally, I spent many years of my career standing on stages and meeting advisors and telling them how a fund or a product could be adapted to the needs of the retiree. And then it was around 2016, 2017, I was working heavily on retirement at IMAP Capital. I was on the Actuaries Institute for Retirement Income. And I started to look more and more into the other side, what I would call the second side of retirement risk management. And that's at the individual level. So remember, the number one, at the fund level, every investor gets the same journey and experience, but we're doing all these things to try and tailor it to this common style of investor called a retiree. But then when you look at the actual individual and you think about the strategic advice or the packaging of different layers of products that you can design based on all these key elements that we can take into account, what's their drawdown rates, what's their age, what's their health, what's their access to government pension? Could we improve their access to government pension by taking on certain products that affect that? Could we affect their ability to deliver their financial goals by a different set or layering of products as opposed to one product that is exactly the same for the person next to them? So this is something that I spent many years then kind of thinking and developing. We've taken that at Evidentia, which was very much Evidentia's belief and philosophy as well. That's something we roll out to their clients, which we call strategic advice. So what are the strategic advice elements that take into account each retiree's individual circumstances, their individual goals, and their strategy? How do the three of those speak to each other to make sure the strategy we're picking is delivering the highest probability of achieving their goals? And we've built some tools and simulators and things that we give to our clients for that. The third part, which is, I think, where the industry is heading, and it's really interesting and dynamic to see this, is, so recap, thing number one is you come up with a product and try and adapt it to retirees. Category two is advisors or clients or models come up with a layered strategy of various products that then try and individualize the solution and customize the solution for individualized needs. Style three is something we call strategy-based investing, where rather than when you develop the strategic advice in number two and you're coming up with all these layered products, what strategy-based investing is, what we're doing at Evidentia is we're trying to plug each of those sleeves that then, when layered together, form a strategy that is tailored to the individual, but is built by a number of several underlying strategies that has been tailor designed. So an example of that might be a simple bucketing strategy. Forever there's been bucketing strategies in advice. It's great for mitigating sequencing risk, and we can get into that later. But the bucketing strategy might be short-term liabilities are met by a short-term low-risk strategy, medium-term by a medium-risk strategy, and long-term by a long-term strategy. But then what the advisor has to do is just go and try and best match what each of those buckets looks like, where what we're trying to do going forward in Evidentia, and what we've been doing for about 5 years now, is actually identifying the exact characteristics that each one of those bucketing strategy buckets needs to exhibit. Maybe the middle bucket, for example, might have an objective to not have a negative return over a rolling 4-year period, for example, because the short-term bucket is extinguished after 4 years, so this bucket should have a positive return after those 4 years. There could be income objectives, there could be fee objectives, there could be liquidity objectives. We're aiming more and more to deliver portfolios that fit into a strategic advice framework for advisors, then to take each of those building blocks, take their clients' circumstance and objectives into account, use strategic advice tools that we're helping provide them to all bring these components together with sophisticated modeling that accounts for their circumstances and goals to deliver an optimized outcome to their client. So that's where Evidentia is at. I've introduced a lot of kind of new ideas and complex terms there, so I hope we can pick it apart. But that's I guess an intro for now into our latest thinking in solving for the retirement problem and moving away from a traditional 60-40 or any traditional single risk profile that is in trying to address delivering retirement income. I think we can do a whole lot better than that, and I think there's a long way to go, but some of these tools and strategic advice frameworks that were built are a great step to getting there.
Thank you so much, Darren. And I might have Frank sort of really take a little bit more of a product focused perspective, particularly on that whole, private credit, liquidity management, and how that sort of fits into that portfolio piece of the underlying in portfolios, specifically around retirement. Obviously, retirement does have a large income focus for some clients and advisors. So, Frank, take it away.
Thanks, Daniel. And look, now, good morning, everyone. As Daniel said, I'm Frank Danieli of MA Financial Group. And just for those of you who aren't familiar with us, we are an ASX-listed alternative asset manager. We manage 10 billion. So in that context, and given what we focus on, I'm going to talk about some perspectives here on alternatives allocation, specifically on this question around beyond 60-40 and in the retirement phase. Now, just to set the scene for that on the second page here of the presentation, the 60-40 portfolio, we all know what it is. But to set the base for this discussion, I just wanted to have a look at over the long term what this portfolio would have delivered to clients on a global basis. Now, this uses JP Morgan and Bloomberg data going back about 3 decades. And the 60-40 portfolios delivered about an 8.5% per annum return with volatility of about 10%. I want to focus on that volatility part. Now, everyone thinks about 60-40 as stocks and bonds. I actually think about it more as the stock component is really about growth, compound return, the bond component really being more about defensiveness, perhaps income generation, and overall balance. The question here, which I pose on the next slide, is what happens if you just add alternatives? So if you take this and you add alternatives, what occurs? You can see that on the next slide here. The outcome, again, over this 30-year horizon, 33-year, in fact, is where the data was available going back to 1990. The outcome is that with alternatives, you get a pickup in return, about 50 basis points. But that's actually not the key thing. The key thing is that the volatility of the portfolio has declined from just about 10 to about 8. So it's a 20% decline in volatility is what you get by adding alternatives. And I think that's particularly relevant in the retirement income phase. Now, before we get on to that, I just want to reflect on how that could be possible. How can it be on the next slide, that adding alternatives delivers this outcome. Now, I think one of the reasons that this has really been accentuated over the past couple of decades is that the traditional allocation asset classes in a portfolio, public markets, which are very good asset classes, they have increasingly become driven by passive money. And passive money is not fundamentally oriented. It tends to be more about sentiment. People allocating in a broad-based way, risk on or risk off. The equities market for that growth component of the portfolio, now 44% of it, of all trades globally, driven by passive money, and that is just growing and growing. Even fixed income, the part of the portfolio on the right-hand side of the slide, that's there for defensiveness. You go back to the year 2000, a negligible, almost zero portion of that money was passive, it was all fundamentals. Today it's 30%, you can see the trend is exponential. Now, what happens on the next slide, you can see if you add significant amounts of passive money into a financial system, has been studied on this in a study from the University of Minnesota. It was only two or 3 years ago, 2022, this came out. It's a complicated study. I've extracted the most important parts of it here, but basically what the study finds is that the effect of adding passive money into a system is that you lose elasticity in pricing. Now, what that means in English is that there is less fundamental marginal buyers of assets to bring prices closer to their, I guess, fundamental value, and that creates more volatility. So we're seeing more volatility in public markets. Now, that's particularly pertinent in the phase of retirement when you may have less tolerance for volatility. But the other thing that's important in retirement is fundamentally, what are you actually holding if you invest in alternatives? I try and cover that on the next page, but alternatives are a really broad description. What it should mean is not that you're allocating into some sort of high risk thing. What it should mean is that you're substituting one thing for another that has a different type of characteristic, and there'll be benefits and trade-offs. So in the case of the defensive part of the portfolio, still sticking with the 60-40, the historical benchmark, if you just think about the bonds component, they're for defensiveness. If you were to substitute an alternative, which for bonds is private credit, then what are you talking about? You shouldn't be fundamentally changing the nature of what you do. A bond is a loan to a company. A private loan should be a loan to a company or an asset. It's going to be less liquid because bonds can trade over the counter. When you make something direct, you don't have the same amount of liquidity. So you're trading off a little bit of liquidity by adding alternatives. But you do also have a different dynamic. You're not in a public market driven by the passive and sentiment-driven trades. It's not a trading strategy at all. It's fundamentals. It's about, I put money out the door for 1 year, 2 year, 3 years. I want to get that money back. I'm contractually owed it. I want to get my income along the way. The same is in fact true in the world of the equity component, the growth component of the portfolio, in my view. Stocks and private equity, if you think about the two, stocks is an ownership interest in a company. If you do private equity, you are simply owning a whole company. That's actually what it is. It's not as liquid. In fact, it's much less liquid compared to stocks because you can't just buy and sell every day. In fact, if you own a company, you can only exit it one way, which is selling the company. And again, in a world where you have high volatility driven by an advent of passive money, and volatility is important to you, adding some of this in your portfolio for a part where you can trade off some of that liquidity, mean you can rely more on fundamentals. What's the business going to earn? What's it going to produce to me in cash flows and dividends and the fundamental earning power of the business? And that's really how I think alternatives should fit in to the portfolio. It's not one bucket. It's actually a type of asset class that can deliver a substitution of the defensiveness or the growth in the right mix that makes sense for any investor, given their preferences, but can have some advantages knowing you are trading off some degree of liquidity. Now, to talk about that the idea, the next 2 slides, that it's not one bucket and that it's an alternative, I want to just touch on a yield alternatives. It's sort of an easy example to talk to. So Just on the next slide here, Toby, the yield alternatives. So I don't think we can just say, okay, we're going to add alternatives to the defensive part of the portfolio to generate income. And the reason we do it is because the returns are going to be higher, meaning more income. That's great, especially in retirement phase. That's the way people would traditionally propose adding alternatives, and they'd show you a graph like this. The idea of the graph in the dark blue is that the alternatives, whether it be direct lending, certain types of real estate income generation strategies, may earn more than a public market alternative. It's not the full picture. It only tells you about return. Obviously, we care about return and risk. Now, on the next slide, even just ranking the return in a broad-based asset class, I don't think really delivers what is important, especially in the retirement phase of someone's income. Just to say, for example, well, historically, private credit's delivered a higher return with less volatility than some other asset classes. Doesn't really tell you the full picture. The reason it doesn't tell you the full picture is that to understand this in how it should play into a portfolio, I think you need to break down what is contributing to that degree of excess return, the higher return or premium you're getting in an alternative asset class, not just the trade-off of liquidity. The reason that alternative asset class should be delivering a premium compared to a public market alternative is that in credit, historically, we're thinking about basically two things. The risk-free rate, we can get on government bonds, for example, and then some sort of premium for the credit risk of our counterparty. If we're lending to bonds for Apple, the credit risk is very low. If it's some speculative borrower, then the risk premium might be high. And that's just for credit risk. When you move into alternatives, you're doing something different. Firstly, you can't trade as much. So there needs to be a premium for that. There's also a lot of work you need to do. You need to go out, source loans directly. Now, you're sort of cutting out the middlemen here, cutting out the banks that are earning fees by underwriting loans and selling them to you as bonds and so on. But there's a premium that you should capture for those things. And that's really that excess premium is what we should be capturing. So think about alternatives in a portfolio. On the next slide, the way I think our framework should work is not that it's in a bucket, but rather that it's on a spectrum of risk. So in the light blue here, traditional assets like bonds, whether they be investment grade or high yield bonds, going up all the way to equities. And what you have there is a traditional chart showing the correlation of risk and return. Lower risk, lower return, higher risk, higher return. Now, when you move into alternatives, what should happen if you do it well for a portfolio is that you should be playing in a curve that looks this way, has a lower return for lower risk assets and a higher return for higher risk assets, but the curve should be shifted up. You can see that with those orange lines there. The curve should be shifted up because you have to have that extra premium for liquidity and proprietary deal flow. And so then the question for a portfolio can become, where do I want to first sit on the risk spectrum? Then, how do I capture a proprietary deal and a liquidity premium for some part of my portfolio to deliver me an outcome of a slightly higher return, but with a significant degree of less volatility? How much of this can I tolerate, excuse me? And that's the framework we need to think through. And what I try and show on the next slide using real data over a long period of time is that, sorry, next slide there, Toby, my mistake. The next slide here, you can see that it doesn't really matter what your bias is. If you're in the retirement phase in the bottom left here and you're more defensive, then you allocate to these alternatives and you do it in the way I described there, balancing where you want to be on the risk curve. You should get some premium in terms of return and you reduce your volatility, but you're balancing it with the right kind of mix of alternatives. It's not one bucket. You can do it in a balanced way. You can see that in the middle pies. And then finally, if you're early in your life and you're into compounding, which I know is not what we're talking about here, you can see that on the top right, you get the same thing, premium returns with lower volatility by allocating this way, but doing it in a framework where alternatives is not one thing, it's understood on a risk spectrum, all the way from a private investment grade alternative to a private sub-investment grade alternative to private equity. And that's the spectrum that we can think about it to deliver, I think, value in a retirement income phase where earning stable, secure income but at a premium rate, it can be valuable for some part of the portfolio. So I hope those slides were helpful. I thought it was just really worth setting the scene around how alternatives can contribute to this discussion and your clients' portfolios.
Thank you so much, Frank. And I sort of might open up the panel now for all of us in terms of really digging into some of these questions. So, and I guess I might sort of start, Darren, first with something around sort of what you mentioned and touched on. You mentioned you had developed tools at Evidentia around model client objectives, outcomes. Did you want to expand a little bit more on what they are and what they do?
Yeah. Oh, sorry. Yeah, I'm unmuted. Thanks, Daniel. So there's a challenge with retirement that I think you have great investment options. You have great insight into what these things do. And as Frank just highlighted, you can have opportunities and identify things that may improve return, lower volatility. But the question I think advisors face with their retiring clients is, which combination of these strategies or investments is really going to do one thing? And there's really one definition of success in retirement, and I think it's the probability of achieving your financial goals given your retirement assets at hand. And so if that's the pure definition of success, and we have infinite combinations of products and strategies we can integrate, we have attributes of those products that might, lifetime annuities might help us with the means test. Does that affect do these people are they anywhere near accessing the government pension? It might help with longevity, but are they actually quite unhealthy and not really worried about longer in life? So you've got all these kind of things that pull and ebb and flow this probability of achieving results. And our question was, how can we help advisors solve this problem? And so what we built is basically a simulator for retirement. And say, you put in the first screen, you put in the client's details. Let's say you put in, I've got a couple, one's 67, the female's 68. They're both just retired. They have $1.5 million of savings, and we need to know a bunch of other stuff about them for their pension requirements. What's their other assessable assets? What's assessable income, and a couple of other questions. So we just get a very easy picture of who these people are, what they have. And then the next screen is the interesting part, is what are your clients' goals? And the advisor can have the conversation about this. Well, to live comfortably, I need at least 60K a year. But really, definitely during my 70s, I want 80 or 90. And I do want to have some money to leave to my kids or have a safety net bucket. And aspirationally above that, if I do have any more, I'd like to pay for my grandkids' schooling fees to go to where I went, because that's what people like to do with their money. So you've got one screen with who they are, one screen with what their goals are, and then basically we then try and twist the conversation around, rather than risk profile, a risk profile survey that's based on your emotion driving what your strategy should be. It is actually based on a bit of science. So we take their starting assets, we take their financial goals and spending patterns, and we simulate that 5,000 times. And in some of those scenarios, there's a worse than GFC scenario the day after they retire, really bad sequencing event. Other scenarios, they might live to 110, a really bad longevity event. In other periods, they might just have year after year of below average returns and just substandard investment outcomes. And so once we've simulated that 5,000 times for one strategy, let's say for very simple, it's a 60-40. Then we might overlay a strategy that incorporates illiquids, like Frank just described, and say, okay, we're going to carve out a part of that and put it as illiquids. Now we're talking about assessing what the liquidity outcome, can they access their money whenever they want, and so on. And so we test strategy after strategy, and then move to the final screen and say, okay, we've tested all these different strategies under all these different scenarios. Under each strategy, what approach or what is the likelihood of achieving my financial goals given my starting position? So very simply, we're just trying to get to the very crux of what people are trying to achieve with their retirement strategy by projecting out the future based on assumptions, based on longevity assumptions, return assumptions, volatility assumptions. So there's obviously this is all subject to that, but it really paints some interesting pictures about things you can do to improve your retirees' chances of success. The first of all is conservative. Most retirees, like with a reasonably large drawdown rate, let's say they've got 1.5 million and they're trying to spend 75,000 a year only, conservative strategies and below, 30% growth and below, 40% growth, just doesn't generate the returns to get them out long enough. And I think we all know that, but this kind of gives evidence to that and very low probability of success. Then at the very high end of return or growth strategies or risk-taking strategies, they achieve their goals and have huge amounts left over sometimes, but there's a big tail of occasions where they blow themselves up because they're taking too much risk and they have a bad sequencing. So you get this nice sweet spot around 60-40, 70-30, interestingly. But then you take different strategies away from a 60-40, say, as we said, a bucketing strategy, and we design a really nice rebalancing strategy around that bucketing. And what that allows us to do is then actually say, well, if you've got that $1.5 million, how much are you spending in the next 3 years? And let's, rather than just put the whole lot in the same strategy, the money you're spending in 20 years is the same as you're spending in 1 year. Let's actually assign money that you're spending in the near term to a low risk strategy, medium term to a medium risk, and long term. And that's where we can then start to say, well, if we wanted to introduce illiquidity, what a great spot to put it in bucket 3, because we know we don't have to touch bucket 3 for at least 7 years. We know that if the markets tighten, liquidity freezes, we just sail through that because we've got a big reserve of short and medium term buckets to deliver our outcomes. So that's a bit about the tool. It guides on that, and it does lead our advisors to have a conversation around bucketing because it mathematically illustrates a lot of the benefits in terms of reducing risk and increasing residual balance or return by taking that approach. So I don't want to talk too long about one thing, but that's a little bit of a
just a quick sort of blow on, because this is something that does come up from an advisor perspective, is just even on those tools, when should advisors be starting that process? I guess is let's say it is a 60-40 traditional portfolio, and they're in accumulation phase. Should they be starting at getting closer to retirement or doing that work beforehand?
Yeah, it's something our advisors have been asking us to do, because we've built this tool for basically at retirement and into retirement. Our next version will go up to 10 years prior to retirement, because people really want to start having and shaping these buckets
That conversation
in the 5 years leading up. And think of the beauty, if you have a 60-40, but you actually have a goal to pay off a fairly large mortgage the day you retire with your super, you should even be de-risking into that mortgage repayment, pay that mortgage, and then whatever's left is in your longer term buckets. And there's really nice asset liability matching happening when you actually recognize your cash flows or liabilities coming to you and adjust your risk profile between those buckets to meet that. So yes, we want to get earlier on in the late accumulator stage.
No, thank you, Darren. Frank, just something for you around this. When we're having conversations with advisors, and this is an interesting one because even within income and retirement-like portfolios that even we run and design, we're looking at this, and similar to what sort of Darren mentioned. Obviously, there is a liquidity sort of benefit, and having assets like yourselves and obviously have that income. I just wanted to sort of get an understanding. Do you think there's enough understanding of the characteristics around private credit amongst advisors, or specifically maybe even clients around this within portfolios? And the reason why I ask this is I think it's very important you're choosing the right manager for this, and a high quality manager, understanding what's in the underlying, and obviously not sort of sitting back and saying, well, I'm happy to be lied to. And there's an income target, here's the return, but obviously there is volatility. But just your viewpoints on that.
Yeah, it's a really good question. I think the understanding varies both amongst the advisor cohorts and actually within the client base, certainly. But I think that to address the question, you sort of need to start with the view that what is private? Like, is private just something that's strange and risky, or is it a really wide spectrum? And certainly my view, I think the data shows that there's a really big spectrum of what is private. There's always been private lending and private equity of a kind in the global economies. If you think about in Australia, with a banking system with what call it $3 trillion of assets on their balance sheet, 3.4 I think it is today, they're all private loans. They're not traded. Some of them are home loans, some of them are business loans, they could be car loans and those sort of things. And they go all the way to things that are really opportunistic and high risk. And none of those things are the same. So I think that there is a great convergence happening between public and private markets, and the access points to what's private are certainly expanding in many ways. But the most important thing from an understanding perspective is not whether the loan is public or private, or whether an ownership interest in a business is a stock or a private equity interest of some kind. It's actually, what is it? You know, it's a business. What is the business? If you're lending to the business, what position are you in? Are you lending at a 25% loan to value ratio or a 70% loan to value ratio? Because it's very different, whichever position that you're in there. And therefore, how is it priced? How is it structured? What other terms do you have? So I think that's where more work can be done. I actually think it's incumbent on the industry to do that work around transparency and disclosure. The transparency and disclosure that matters a lot is not just what's in the tin. I mean, that's a basic piece of hygiene, like let's disclose what's in it, but also how did you do it? What are you doing it? How did you originate these loans? Why does the opportunity exist? Are these loans that banks used to do, but they can't do anymore because of regulation, because they're streamlining their business, which I think is the most attractive part of the private market? Or alternatively, are these things that banks never did because it's actually distressed debt turnaround situations and they can't do that and they don't ever want to do that, but that's why you're earning a 15, 18% return. There's a totally different spectrum between those things. And what's really important, I think, for advisors here and in working with their clients on this is say, okay, I understand that the liquidity in this product may not be daily, maybe it's monthly, quarterly, yearly, whatever, but a different horizon. But with that different horizon, I'm earning a premium. Why are you earning the premium? Are you earning the premium for taking an appropriate amount of risk or an excessive amount of risk? And that really requires digging into the manager selection for sure, but also just the nature of what you're actually exposed to.
I think just to follow on that, you mentioned transparency. Do you think, is there enough transparency? Like looking at, obviously, you also talked about, there is alternatives having a spectrum of risk, and obviously looking from investment grade to the equivalent, equity equivalent. But do investors know, just flowing on a little bit more on that and just hashing out, is there enough transparency there? I think from my point of view, I think it's manager specific and having good quality managers like yourselves. But is there that enough transparency?
The truth is it varies. And there are some areas where there's enough, and there are some parts where it's not. I think the transparency is in two ways. As I mentioned, that what's in the tin, what's the nature of the process you go by, what do you do, and then also transparency around the risk and performance characteristics. So I think about each of those differently. If I think about something as just, I guess, a tangible example with this listed investment trust called MA1, we put a huge amount of disclosure out around what's in the tin. They're way more than is legislated or needed. But actually, because it's about just showing what's in it and letting people make the right call. That's what's in the tin. Then we love to talk about, like, how do we go about originating? We believe in proprietary origination. Why? We believe in co-investment. Why? We believe in doing a whole bunch of risk analytics, like red teams and war games, we call them, sensitivity analysis about what happens if things break, if the world gets bad. And then there's the third part, which is about helping people to understand the risk spectrum. In lending, your goal is to avoid losers, not pick winners. Like you're not about trying to pick the next Apple. You're actually about just saying, I want to lend in a way where I get my $100 contractually owed to me, paid back with high certainty. Probably better said, with low certainty, it doesn't get paid to you. My income is going to be consistent. But not everything's going to work. And so, what are the scenarios where some of the loans in your portfolio fail? Do you understand them? How prevalent is that? Is it systemic or is it a small proportion? And what is the current performance or delinquency characteristics of the book? That latter part, I think that in some pockets of the industry, we probably do ourselves a disservice by trying to say things are always fine. It's impossible. There are loans today that are going to default at CBA. CBA will not fail today, I believe. That is fine that the default happens. The question is it high? Is it a large portion of your portfolio? Is it small? What are you doing about it? And the more we disclose about that, actually, the better, especially if you believe that the industry is about, partnering with banking institutions or participating in parts of the market they can't serve best themselves. And so you just sort of have to behave like that. I think that's really going to be the key. The disclosure around all three of those is important, but especially the latter, the performance and what's happening in the book and what will change through time. Banks stress test their book. Private lenders should stress test their book too and talk to their clients about it. So then that Darren and his team can run the kind of analysis you just talked about, run those simulations on client portfolios, and people then make the right choice. And I think as a manager, you end up getting the right client base as well.
Thank you.
Can I just ask a question? So, because something you mentioned the blurring lines between private and public markets, and you can take a private book of loans and put it in a LI listed investment trust, and then it's very, very liquid. But what we've seen looking back in time is that perhaps the managers of those LITs haven't been responsible enough in kind of reducing the size of it if the demand was not there, if there were excess redemptions, they were not keen to buy back their own shares or return capital to shareholders within that LIT. Do you see that evolving? I think from my point of view, I'd be much more happy to put private-like assets in separately managed accounts if we knew we could rebalance them frequently via an LIT structure that was kind of a version 2 or bit improvement. But I'm not sure whether we're there yet. What are your thoughts?
Well, that's a really good question. I mean, I start with the view that I think if you're going to do an LIT, it should be an access point, not a sort of fund in its own right. That is that you've got a big portfolio of stuff. This is your way to access that if you want daily liquidity, noting the price could trade at NAV, slightly less than NAV, go up and down. Here's your unlisted way to access the same thing. So they're channels, not portfolios. So you got a big portfolio because that gives you diversification of the things you want. So you start there. The other question is, okay, if you want to be in that listed space, so because some clients, as you say, Darren, they need that either actual or contingent liquidity and if they need it daily, then an LIT could be a good example for them. But what are you doing around managing NAV and price to NAV? Prices can trade away from fundamental values. So to start with, you got to know the fundamental value. So you want independent valuation assurance and things like that. So we know we're talking about the same thing. So you do that. I think that's the first thing that needs to be done. And the second thing then is that you actually have some sort of mechanisms to be able to manage NAV or for people to be able to effectively get out at and redeem at NAV over time. I think there are two in the market of us and the Pengana one actually that use a mechanism that's actually taken from what's done with US BDCs, which is a 5% quarterly buyback at NAV that enables people to have that sort of option. And then there are other mechanisms though that should be and can be implemented, as you say, whether they're on-market buybacks or other ways of, managers trying to build the right liquidity and depth and trading around the vehicle that helps. I think what is bad is if that space is viewed by managers as a way to sort of grab permanent capital. That's not what it should be. This should be about helping clients to have access points to something they could get unlisted, but with different characteristics if they need it.
And that's the real risk as well. In the past, there are managers that it's been used as a tool to lock up as much and get a fee in perpetuity. but for the right reasons and the right products, I think potentially could work. But just sort of flowing on from that and just looking at maybe a question for both of you around this. Obviously, what we're looking at clients, we're looking at advisors around this, and what they're sort of talking about is what are the best ways in protecting against downside risk? That's what these portfolios are trying to do. I think we look at it from a perspective of, okay, well, the portfolio should, as a whole, advisors should be looking as a whole, having much less risk in these portfolios or overall risk in these portfolios than probably a standard accumulation like a portfolio. But given these clients are often very, very loss averse, what's the viewpoints around having or protecting against that downside risk? Is it specific around the assets, or is it specific around how portfolios are designed, blended, and what their objectives are? I guess that's probably where we wanted to sort of discuss a little bit more.
Yeah, I've kind of been on both sides of this fence. I think there's a tendency for multi-asset portfolio providers to go to retirees and say, I'm going to deliver you a portfolio that's designed to avoid risk via dynamic asset allocation and liquid alternatives. Bang. Oh, that's a great idea. And it's been going on for 10 years. And there's been 10 years of disappointing performance from those portfolios, I feel. People might be hating me right now, but and I've managed two of these separately at different points in time, and I don't think I did particularly, I thought did okay, but you're really fighting, dynamic asset allocation is pretty hard, but you can design processes and things to do it. But where it's the hardest is on the downside, protecting on the downside. And if you look your clients in the eyes and say, I'm going to avoid risk by selling assets when things get scary, you inevitably, something scary happens. You sell risk. Markets usually bounce back quite quick. You might now one or two out of things, but markets are only down over 12 months, 20% of the time. So you've got an 80% chance of being wrong. Then markets rally. A lot of what I see is then people start to defending, it's overvalued, the risk is still there. And now risk averse human nature comes out, and these portfolios have promised to deliver 60-40 on average, but with downside protection by DAA, have sat a lot closer to conservative levels and failed to deliver their return objectives. They've absolutely delivered their risk objectives, but the PM team has been too risk averse throughout the cycle. So then, part of that at Evidentia is to be balanced and actually have a belief that markets are going to go up more than they're going to go down. DAA needs to have a similar bias where you actually are trying to capture upside. And then, so what are you doing then? Are you just throwing retirees into these portfolios that are exposed to the full drawdown? Well, no, that's not what we're doing. Within the fund, we're saying it's very hard to outsmart the market, particularly on the downside. Upside, it's a little easier. Odds are on your favor. Within the strategic advice framework, we can structure the individual client's portfolio so that downside risk in their equities bucket doesn't bother them. They can ride that out because they've got 7 years, and we're only ever going to rebalance out of that bucket 3 in a 3-bucket approach when it's above its high water mark, or when the market's up. When the market's down, the client, based on their individual liability profile, is just going to say, well, I've prepared for this. I'm emotionally strong. I don't need to worry about selling because Trump's come in and done his Liberation Day. I've got 7 years, and never in the past have markets not been up over 7 years. So I'll just eat into my buffer until the time's right. So we're managing downside risks through our strategic advice and using DAA to try and really add value above a benchmark over time. And so that's a kind of, that's where we stand on that, which is quite different, I think, to a lot of retirement portfolio approaches.
Yeah, what I liked about that answer, Darren, is that to me, it's about predicting the downside is about being able to have the right fundamental view for enough of your portfolio, and then also being able to manage the temporal dynamic timing. It's the old saying, it's time in the market, not timing the market. You can't time the market, it's impossible. But that also links to this idea that a trading strategy, I think, especially in retirement phase, is really risky. I liked what you said there around it's not trying to sell assets in a bad time to deliver you liquidity. Is there a part of your portfolio where you can structure where you're going to be naturally or contractually getting a degree of natural liquidity in your portfolio? That could be bonds, it can be private loans, it could be all sorts of other types of assets, it could be infrastructure things or whatever, where there is a contractual obligation from someone, a counterparty, hopefully lots of them in a big diversified portfolio, to give you your principal back. That could be bonds that mature, it could be loans that also hit their maturity date or that have amortization. And so you're getting a whole bunch of principal that's recycling in your portfolio. And that means you have that natural liquidity. You don't have to sit there and hope that someone's going to pay you some price for that to buy that loan off you. It's just that the borrower owes you the money. And then you can take that that capital being returned to you, and you can either invest it again, or you could use it to balance your lifestyle in a time when there's a broader market drawdown. So I think there's ways to think about the laddering of portfolios like that with a fundamental view on assets versus a trading view that can also help.
And just to dig in a little bit more into that one, just from an advisor perspective, and maybe Darren maybe provide a viewpoint on this one. Would you avoid looking at just investment style? Let's say it's a multi-fund type portfolio, looking at investor type of fund styles. Let's say in equities, would you avoid your small caps? Would you have more volatility control, income paying, alternative income type managers? Is that something that can be used as a tool as well as part of that? Maybe if it's not DAA.
Overall resilience in the downside capture is, I think, what you're getting at. And if I was managing a retirement portfolio, an accumulator portfolio, they should have different growth allocations to begin with, but let's say they're the same. Differences within that is higher focus on quality and lower downside capture in those global equity managers, Aussie managers. There's a whole list of them. I won't name names to remain neutral here, but we know the ones that are that really focus on companies that have high moats, low leverage, very resilient sales growth, and so on, that are much better to protect on the downside than your general cyclical or industrial company. And I know Frank's relaying the same message on the private market side. There's private market exposures that are really going to be reliable in delivering that income, even if we are in an economic slump. And there are others, particularly on the PE side, that are really dependent on the economy going well and a leverage to consumer or leverage to tech rollout. And you carry a bit of risk there, obviously return as well. So on both sides, retirees need to think about, you don't want to have those big drawdowns.
And what are and this is just for both as well, looking at what are some of the challenges with clients in regards to interest rates? Obviously, we've seen interest rates starting to move. I think, Darren, from your perspective, it's more, do you want to actively manage that duration piece? And Frank, from your side, it's just looking at how does that impact private credit?
Well, medium to long-term returns on bond indices are pretty easy to estimate. They're going to be pretty close to the starting yield. So we don't try and capture the shorter term volatility that we've seen. We think of a kind of a long-term rational return you should be getting on a bond portfolio. And if it's not there, we're going to naturally allocate away from it. So in 2021, we were holding almost no long duration bonds because the return just wasn't there, and it was better found elsewhere, trying to allocate into things, absolute return or low risk equities and so on. And as yields have come back into the market, we're allocating back in. So I guess the main thing I was saying there is we're not day trading this. Maybe our underlying managers are that we allocate to, but it's not in our mandate to be flipping the portfolio around. We're trying to just capture those big long dislocations like sub 1% interest rate yields and interest rates.
And Frank, from your side, I guess looking at this affect private credit in general with some of the interest rates.
Look, I mean, not all, but many parts of private credit are floating rate assets, though there are ways to do it in a fixed rate format as well. I think to Darren's point, trying to bet on macro moves has been it's very, very difficult. I don't think there's a lot of people with great track records of doing that as it pertains to betting on interest rates. And I think if you really see credit of any kind as part of defensive allocation in your portfolio, then you really shouldn't be making bets like that, other than perhaps protecting from extreme events with some sort of almost like a hedge. I think the right way to think about it is more like, what is a likely level of normal and sustainable interest rates, and what premium do I want to that? How that premium sits, whether you're in a public bonds or you're in private loans, it should really just be about the premium you're getting to that. Maybe you want to have some degree of hedge in your portfolio, and you can balance that, but I just focus on the premium. I also think we've kind of gone through a cycle. I was over in the US recently, and the head of a very large wealth management business that advises sort of ultra high net worth clients there said something to me. She said that her view is that we're going through a great normalization at the moment. It's a normalization of interest rates and these sort of things. And who knows whether that's right or wrong. I think that we're probably at or around long-term normal levels for rates, if I give a personal view, but we don't try and bet on that when making investments. And I don't think it's sort of ideal for advisors or clients to bet on that either.
Thank you. And I think this is, in summing up and looking at this whole topic, the difficulties around constructing portfolios with clients that have objectives that are not in the conventional 60-40 accumulation framework. I think where it really falls into is having the right framework that is a bit different to that of accumulation type clients, and obviously focusing on the retirement sort of stage, as Darren mentioned. It's having that framework, looking at the underlying, and obviously looking at the different pillars or viewpoints that you can have as part of that in terms of the quality of assets and the types of managers used. And I guess from your side is having alternative managers that have that transparency, have that process that is key. Toby, I might sort of hand it over to yourself.
Right. Look, thank you very much, Daniel, Frank, and Darren. It's always a pleasure for me participating in these webinars when the presenters bring such obvious expertise and a depth of knowledge and experience to a topic which is central to what we all do. So I've really enjoyed today's session. I think I've taken a lot out of it, and I hope each of you has too. So just a quick reminder, tomorrow we'll be focusing on building portfolios where there are responsible investing goals. We'll be talking with Diana England from S&P Dow Jones about how you can understand ESG data and access that, and we'll be talking with Mark Jordan from Nanook, who have a long track record in building sustainable portfolios, and how those fit into a green or climate friendly oriented portfolio. And then on Thursday we'll be talking with Mike McCrory from from BlackRock, Chad Heitzman from GlobalX and Hugh Lamb from BetaShares about investing in the new economy, taking advantage of what the world is going to look like in 5 years' time or sooner, perhaps. The awards, I'd encourage you to enter that and advice and action. So Daniel, Darren, Frank, thank you very much for today's presentations, and we'll look forward to having each of you join us again tomorrow. Right. Thanks very much.
Thanks, Daniel. Thanks, Frank.
Thanks, Daniel.